Every parent of a child with special needs faces the same fear. What happens when I'm gone? Life insurance is one of the most effective tools for answering that question, but only when it's paired with a properly drafted special needs trust. In this video, we'll walk through how this combination works, what type of policy makes sense, and the mistakes that can undo everything. Here's why this pairing is so common. Governor benefit programs like SSI and Medicaid are needs-based. They cap the assets a recipient can hold, typically $2,000. If a life insurance policy names your child directly as beneficiary, the death benefit can wipe out their eligibility the moment the money arrives. The fix is to name the special needs trust as the beneficiary instead. The trust holds the funds, the trustee manages them, and your child keeps their benefits. The first question most families face is term or permanent. Term life insurance is affordable and provides a large death benefit during your working years, but coverage ends when the term expires. If you outlive the policy and haven't built other assets for the trust, you're back to square one. Permanent life insurance costs more, but it never expires. The death benefit will always be there, which makes it a more reliable funding mechanism for a trust designed to last a lifetime. Many families with a special needs child choose permanent coverage for exactly this reason. There's a specific type of life insurance that's particularly well suited to S&T planning. Second to die, also called survivorship life. It covers two people, usually both parents, but only pays out after both have passed. That timing lines up perfectly with how most families plan. They intend to care for their child themselves for as long as they're alive. The trust only needs significant funding once both parents are gone. And because the insurer isn't paying until both policyholders have died, premiums are considerably lower than buying two separate policies. Here's the step that actually makes this strategy work, and where many families get it wrong. The trust must be drafted first. You can't name a trust that doesn't exist yet. Once the S&T is in place, contact your insurance carrier and update the beneficiary designation to the exact legal name of the trust. Then get written confirmation. Beneficiary changes are not always processed correctly, and a mistake here can have serious consequences. One more thing, do not name your child directly, not even as a contingent or backup beneficiary. Any direct payment to the child can still trigger benefit loss. Calculating the right amount of coverage is the part most families find overwhelming. There's no single formula, but 4 factors drive the number. First, estimate the annual cost of supplemental care, what the trust will need to pay for beyond what government programs provide. Second, consider the beneficiary's life expectancy. A trust that needs to last 40 or 50 years requires much more funding than one supporting someone for 10. Third, account for other assets. Life insurance doesn't have to be the only funding source. Retirement accounts, real estate, and family contributions all count. Fourth, factor in a conservative investment return if the trust assets will be invested over time. An attorney and a financial planner working together can help you land on a realistic number. Now let's talk about what goes wrong. These 3 mistakes show up in our practice regularly. Mistake 1, naming the child directly on the policy. This is the most common error and the most damaging. It bypasses the trust entirely and can eliminate Medicaid and SSI in a single transaction. Mistake 2, trying to update the policy before the trust is drafted. Naming a trust that doesn't legally exist yet is meaningless. You must create the trust first. Mistake 3, letting the policy lapse or neglecting to keep the trust funded. A trust document without assets is just a piece of paper. Review both the policy and the trust periodically to make sure they're working together. Life insurance is one of the most reliable ways to fund a special needs trust, but only when the pieces are put together correctly. The policy type, the beneficiary designation, the trust document, and the funding amount all have to work in sync. At the law firm of Benjamin Eckman, we help New Jersey families build complete S&T plans that coordinate life insurance, estate planning, and government benefit rules from start to finish. If you'd like to schedule a consultation, call 908-206-1000 or visit ekman-elderlaw.com/book-a-call. We serve families in Union, Wayne, Hackensack, and throughout New Jersey.